All right, I think we are live here. Good morning, everybody. Welcome to our second webinar. We're going to be holding these every quarter based on our market commentary that we write at the end of every quarter. We have a lot going on in the markets right now, unfortunately, and so we wanted to speed this webinar, move it up a week so that we can make sure that we address any conversations while there's still a lot of volatility going on. For you today, Nick is going to share that right now. So every quarter, our commentary is called the No Risk Report. It is published in Forbes, written by Dave Thomas and myself. The one for the first quarter of 2025 is titled Tariff Tantrum 2.0, Global Pivot or Passing Storm. We'll get into that in a little bit. Let's look at the agenda. We're just going to have a brief introduction. We're going to have a brief market update. We're going to cover the no risk and also some updates from the navigator. Next slide. Everybody on this call is familiar with Equitas, so I'll just go really quickly here. We've got 200 years of combined experience. We serve institutions, high net worth families, and everything in between. We've won awards for our work in investments, and we've also got some great strategies in every investment class. And this is just a brief summary of some of the many no risk reports we've written. So let's get into it, Nick. All right, so let's talk about market volatility. This morning. I came in early and got this screenshot for everybody. Year to date, this is the S&P 500 down 20%. We have the NASDAQ, it's down 20%. And then other categories have done differently. No, I'm sorry, go back to that one. We've got bonds that are basically holding steady. International was up 7% for the quarter, and EM also had a pretty good showing. But let's take a little bit of a longer term view on the next slide here. This is 5 years. So you can see by that 5-year marker, the market has been up 80% in this time. And Nick, if you could use the mouse on, I want you to just kind of draw back along that line, starting from the right-hand side. If you're able, I don't think we're able to see the mouse, unfortunately, but if you could just look with your eyes here, the dot on the right-hand side, that's where we're at today, and Nick is working great. So the flat line, please. If you go back about a year, so this is about a year's worth of gains that have been erased with what's going on in the market right now with tariffs. And I've been consulting for the Tulane Algorithmic Organization for about a decade now. And through that, I really gained a large appreciation for price levels, for some of the patterns that happen in the market. And Nick, if I could get you to just go back to 22, there's a peak right around there. And so you can see that's almost very, very close to where we are today. And that, I will say, is going to be an important resistance level. So we don't know exactly what's going to happen, how long this is going to go on with tariffs. To us, this is purely a political question. We're not going to make comments on politics or kind of speculate which way things are going to go, other than to just say that this is a lot of volatility in the market. Market participants, investors are hyper focused on what's going on right now, and there's a lot of uncertainty. And so when there's a lot of certainty, you can imagine it's like a cloud that is in between you and your vision of the future. It's hard to really understand what's going to happen in the future, and because of that, the market is just discounting all of it. There's more panic in the markets today than there will be a year from now. And we always like to remind investors of the advice from Dow that the current moment will not last forever. There's always something on the other side. So let's go to the next slide. So now we're going to get into some of the no risk report charts. Every quarter we find a few charts that we think really speak to the market situation. This is the most important one, I think. So we call it Tariff Tantrum 2.0. And the 2.0 is because we think that this has happened before. If you look at Trump's first term, that's going to be the blue line here, and the dates in blue at the bottom of the graph correspond to Trump's first term. There was a big sell-off when he instituted the tariffs the first time around. Then he made deals, and the market recovered and went on to new highs. We're not predicting that exactly to happen again this time around, but we do think that there's some important similarities in this chart. The orange line is where we were at the end of the quarter. We've gone down another leg from that, probably about halfway through where you see the date on the chart is how far we've fallen since then. But potentially, we're not sure what happens after this gets resolved. You see a lot of companies trying to ask, a lot of countries, trying to ask for deals right now. Anything can happen. We're not predicting anything. At Equitas, we always counsel for balanced portfolios that can survive any economic condition. Let's look at the next chart. So we talked about what happened this quarter with the down draw on the S&P, the upswing in the international markets, and also the positive returns from EM. And this is what that looks like over the past decade. You have the brown line at the top. That's the S&P. That's the U.S. market, which has just clearly outperformed the international EM non-U.S. markets head and shoulders, man. I mean, it's like your head and your belt here almost. The difference is so stark. So what I really wanted to do is give you guys a 10-year perspective here to help you look at long-term horizons for your investment portfolio. What we're seeing right now is a temporary dislocation, and again, anything can happen going forward. We have another way of looking at this on the next slide, and this is simply a comparison between the S&P 500 and the international stock market, which we call the MSCI EFA. And the blue bar at the bottom is every quarter when international markets outperformed the US. The green bar at the top is when the US has outperformed international. And so when you're looking at this, you see a little bit of blue on the left, but primarily it's just a lot of green bars with a blue bar every so often. Now, on the right-hand side, this most recent quarter is the biggest outperformance of international markets in the past 10 years. But if we're kind of looking at this holistically, this is not enough to say that a new trend has been established. It may, but we have to watch and look to see what happens. We'll get into this a little bit more when we talk about the Navigator and some of its positioning. Let's go to the next slide. So at our last webinar, I spoke about the 10-year yield. This is something that everybody is watching. There's been a lot of chatter about the bond market recently, about yields kind of going back up. And again, perspective. Really want to help our investors keep a good perspective. So we are still very healthily below the 5% level on the 10-year. We've had a couple of peaks here. We're in a trading range, and honestly, I expect this to continue. So I've seen a lot of alarmist commentary out there about spikes in the yield. Just know that we are still within a comfortable range. The 30-year yield is at a very similar pattern here, different numbers, but I like to focus on the 10-year yield because that's closer to what the mortgage rate is. And so I think it has a bigger impact on the economy. Let's go to the next page, Nick. And here we're going to get into some of the Navigator positioning. So we're looking at what changed between the beginning of March and the beginning of April. These are some of the indicators that we look at generally for the risk budget. So this will determine how much really is invested in equities versus bonds and cash. So we look at the equity bond relative strength, and we look at the global high yield, that's the OAS, that's the option adjusted spread. So it looks at how much more yield you're getting for high yield than you're getting for investment grade debt, like your blue chip companies. And when that ratio kind of widens, that's a symbol that there's a lot of uncertainty and credit risk in the markets. And so we saw that those two factors particularly changed by the end of March. And this is what caused the navigator to put a 45% allocation to the safety of government bonds in the portfolio to start April, which was fantastic because it really helped stem the losses with some of those deep drops in the equity markets. Let's go to the next page, please. And this is the categories where the navigator did go into for the start of April. As I mentioned, U.S. short-term treasuries, that's 45% of the portfolio. And then so we have roughly about another half of the portfolio. It's about 20% in international, 20% in emerging markets, and about 11% in the S&P 500, and a couple other percent that are spattered around there. So in terms of our risk budget, the navigator moved more heavily towards international and emerging markets. It saw the big outperformance. That's where it wanted to use the risk budget. But we did maintain a very small 10 to 11% allocation to the S&P 500. Let's see what we got is the next slide here. Okay, so that was the end of the charts that I wanted to show you guys for this quarter. Here's some biographies on Equitas Capital and the wonderful people that we have working here. We have a slide on disclaimers that we're legally required to show you. And now I'd like to open it up for questions. You guys should have a Q&A on your screens. You guys are welcome to throw any questions in there that you may have. Let's stop sharing. Great. And let's see if we have anything on the Q&A before we close out this webinar. No questions yet. So this is your time. If you have any questions whatsoever, feel free to throw those in there. Otherwise, I'd just like to summarize this webinar for you. We looked at the performance of the equity markets. We put those into some longer term perspectives. We talked about some key levels. We talked about comparisons between the US and international and emerging markets, which are looking more positive in shorter term time periods. It may be the start of a new trend, but it's too early for us to pronounce whether a new trend has actually started or not yet. So we have a question here. Nice to have bonds and the navigator, but isn't that more than offset by the 20% each to the navigator and EM? So what the navigator is designed to do is not to perfectly predict the market and allocate perfectly every time, but just to sort of take the temperature of the market and, you know, 6 different areas in equity, 6 different areas in fixed income, figure out, you know, where the balance of the indicators are signaling, and to give hopefully a balanced portfolio over time that can tilt more into growth or can tilt more into safety depending on the conditions. Nick, can you show the slides again? Let's show the risk budget. If you look at the percentage of the countries above the 50-day average, you look at the leading indicator index, you look at the purchasing managers index, even still the shipping index, really a lot of the long-term economic health indicators still are in very healthy ranges. We had some moves before the end of March, particularly with the equity and the bond relative strength and the high yield spread, that showed that there was some concern out there. This speaks to the dislocation in the markets right now really being more about politics than about the fundamentals of the economy. And this is an important point that I didn't bring up during the presentation, but you look at the sell-off in the markets today, and the only other times that you've seen something of this magnitude, especially within this short of a time, has been COVID. It's been the global financial crisis. It's been the dot-com bubble. And when you look at each of those situations, you could talk about the leverage in the system for the financial crisis. You could talk about the fact that there is a health pandemic that is spreading across the world. You could look at valuations that were just at sky high levels. And we, in the last webinar, last quarter, we looked at valuations and we said, you know, they're high, but they're not kind of .com insane territory. So this is what gives us confidence to say that what's going on right now is a dislocation. And again, anything can happen at this point. We're not going to make predictions that have to do with politics. That's not our core competency here. But if we can get a resolution, if the first term was any guide, once you do have a resolution, we think that there's a lot of cash that's sitting on the sidelines. We may be able to have a decent recovery here. So there's still a lot of questions. We can't make any definitive statements, but it's at the time where we think balanced portfolios are really showing their worth, both protecting on the downside from the volatility here. But, you know, given the fact that there's a possibility this gets resolved next week, a new plan can get announced. It may happen next week. It may happen in 2 weeks. We hope it happens sooner rather than later. I think that with a lot of this disruption that we are seeing, that it's pointing to a resolution that may come sooner rather than later if the plan had been chosen to phase these tariffs in over weeks or months. I think that would have led to a more extended resolution, but we'll see. We'll see. And I think it's best to have a good portion of your portfolio that is in safety right now. And I think that it's best to have a portion of your portfolio that can recover. And going back, Nick, to the 5-year chart on the S&P 500. So I think that we're at a really key level here. We like to look at minimums. We like to look at maximums. I think there's kind of a narrow channel here. I think it's totally possible we could drop another 5%, but I think that a lot of the damage that's going to be done, God forbid we have, you know, an extended tariff crisis and global trade breaks down. I mean, if that happens, all bets are off. But if we're able to, you know, kind of stay in this level, hopefully work towards a resolution, I think a lot of the damage has been baked into the market by now. So, you know, I think it's important to have an equity allocation at this point. We've been getting a lot of calls from clients asking, you know, it's a great feeling to have clients call a financial advisor in this market and ask, is it time to buy yet? That is a client who has listened to us, who has read our no risk commentaries for years, who is very familiar with the ups and downs in the markets, who has a balanced portfolio, that they know that, you know, their short-term needs are going to be covered, and they're thinking about the long term. And that's really what we want to emphasize here for our clients at Equitas, is think about the long term. So if you do have a fixed income allocation, if you have a bond allocation, if you have a cash allocation, and you have more than enough to cover your needs for the next year or so, it's okay to think about taking on a little extra risk budget, I think, right now. So if you're okay with your needs for the next year and you think it's a buying opportunity, certainly contact us. Let us know as soon as possible. And I hope that answered your question. Let's see if we have any other questions before we resolve this. We have a question about year-to-date returns. Year-to-date returns for the Navigator are only down 5% versus the NASDAQ down 20 versus the S&P down 15. Obviously, the bond allocation has been part of that, and the diversification has been part of that as well. It's not an equity strategy, so it should be compared versus a 60/40 index. The global 60/40 was roughly flat. But there's going to be times of dislocation, and again, you want to look at that long-term outperformance, and the long-term annualized return of the Navigator is roughly 11%, and 23 was roughly 15% up. 24 was roughly 15% up, while ahead of the index. We gave a little bit back in comparison to start the quarter, but we're still very happy with how it's navigating this time of intense volatility. And with that, we'd like to thank all of you for joining us today. If you have further questions, feel free to email us, give us a call. We want to make sure that you guys have all of your questions answered, and we'll see you next quarter. Thanks.